Why would the IMF use the phrase a second Great Depression in a report that they know the entire world will read? To be more precise, the IMF stated that large challenges loom for the global economy to prevent a second Great Depression. Are they saying that if we do not change our ways, that we are going to be heading into a horrific economic depression? Because if that is what they are trying to communicate, they would be exactly correct. At this moment, global debt levels are higher than they have ever been before in all of human history. And in their report, the IMF specifically identified global debt levels as one of the key problems that could lead to another financial meltdown. IMF, Latin America will suffer worst economic crisis in its history. ECLAC says the outbreak in 2020 will cause the biggest economic crisis in Latin America and the Caribbean. The Spanish International Monetary Fund has reduced growth prospects for Latin America and the Caribbean, predicting that economic activity will drop by 9.4% this year, driven by the coronavirus pandemic. To assist these governments, the IMF approved $5.5 billion in additional loans to 17 countries in Latin America and the Caribbean, and flexible credit lines for Chile and Peru, and renewed access to Colombia and increased premiums in the region to $107 billion. The World Bank forecasts for the region show a 9% drop in gross domestic product. ECLAC has indicated that the pandemic in 2020 will cause the greatest economic crisis that Latin America and the Caribbean has experienced in its history for as long as statistical records are available. During so-called debt crisis, the region's GDP contracted by 2.5% in 1983, and during the international financial crisis in 2009, the contraction was 1.8%. There has been a significant decline in the working population of the region. This effect has been particularly strong in Colombia, Mexico, and Peru, but other countries in the region are still waiting to update these figures. Peru has been the country most affected by the epidemic. It is estimated that the decline in the economy will be 14%, above the regional average this year. Among the causes of the sharp decline are raw materials, especially copper. Tight deadline significantly impacted consumption and led to a series of mass layoffs, and unregistered work is extremely common in the Peruvian labor market and reaches 70% of the employed population, even at the regional level. Mexico. In Mexico, the IMF predicts a 10.5% drop in economic activity. The effects of COVID-19 worsened with a decline in investments before the COVID-19 outbreak, as the decline in oil prices, volatility in international financial markets, disruptions in global value chains, and worsening trust among businesses. The Mexican Central Bank is expected to lower interest rates further in order to absorb the shock of the crisis and maintain the functioning of financial markets. Argentina. Argentina's GDP is expected to contract by around 10% in 2020 as risks become more severe. The country's growth deteriorated with the expansion of quarantines in Buenos Aires and the metropolitan area. The country experienced a fall in foreign demand and a decline in commodity prices. Uncertainties regarding the debt restructuring process continue to weaken confidence in Argentina. Brazil. The IMF expects Brazil's real GDP to decline by 9% and rebound by 3.6% in 2021. The authorities have responded to the pandemic with decisive interest rate cuts and significant fiscal and monetary stimulus programs that include direct cash transfers to the most vulnerable population. The IMF believes that the withdrawal of this stimulus would affect growth in 2021, as the Brazilian economy had not yet recovered from the aftermath of the 2015 and 16 recession when the COVID-19 crisis emerged. Consequently, an accommodative monetary policy will be essential to support a cyclical recovery, and a resumption of the government's fiscal and structural reform program is crucial to preserve fiscal sustainability and foster potential growth and investor confidence. Chile. For Chile, the multilateral organization projects that economic activity will contract by 7.5% this year and rebound by 5% next year. After the good results of the first quarter, economic activity is expected to contract sharply in the second quarter due to strict social distancing measures and, to a lesser extent, the weakening of external demand. A rebound in activity is expected for the beginning of the third quarter and should continue in 2021. Thanks to the unprecedented measures taken in the fiscal, monetary, and financial areas, the unemployment rate in Chile reaches 11%, and this would rise to 26% in the population between 15 and 26 years old. Female employment also fell to 38%. Colombia acted early to limit the spread of the virus, but economic disruptions related to the global quarantine, such as falling oil prices, are expected to trigger the Andean country's first recession in 2 decades. The IMF anticipates that Colombia's GDP will contract by 7.8% in 2020, but should grow by 4% by 2021. The Banco de la República has cut monetary policy rates and supported market liquidity, and a fiscal rule has been suspended for 2 years to provide sufficient flexibility to deal with the health and economic crisis. Colombia faces a sharp drop in employment, reaching unemployment rates of 24% in the country's principal cities. Central America and the Caribbean. Central America and the Caribbean will experience a deep recession in 2020, with gradual recovery starting in 2021. The strongest impacts of the trade contraction will be felt in Panama, El Salvador, and Nicaragua. The collapse of tourism will particularly affect Costa Rica. Countries of the Northern Triangle and Nicaragua will be affected by the decline in remittance inflows. A mitigating factor is that the fall in oil prices has improved the terms of trade in Central America. The Caribbean economies have succeeded in flattening the contagion curve of the COVID-19 pandemic, but tourism has come to a standstill, and key markets where tourists came from are falling into a deeper recession. So the region is likely to experience a very dramatic and prolonged contraction in economic activity. The Economist added that we must also rethink certain contributions and create expectations to make the market more flexible, such as pension contributions for 6 months. The employer's contribution must be eliminated or substantially reduced. Nevertheless, the professor is also optimistic that the Colombian economy will soon begin to show signs of recovery. Even if these measures are not implemented, we will witness recovery in the coming months. Although this is the highest unemployment rate in our history, the financial system has not become as weak as it was during the 1999 crisis. This would allow us to provide credit support to the private sector, so the recovery process might not be as slow as it was during the previous crisis, when we spent more than a decade returning to single-digit unemployment rates. Economic policy is aimed at mitigating the problem of recession so that the recovery is rapid expect in labor policy. If the government is not willing to make these reforms for political reasons, it will slow down the recovery of employment in the country, concluded Posada. Most of the idea, comment, information, and criticism containing in these videos have been created by Daily News Report. Before making any important investment decision, use the information contained in these videos as a starting point for conducting your own research. If you make any investment or legal decision, it is advised to consult an expert before making this decision.